Hello and welcome to Chapter 8 of our online review program for COMM 217. Today we're going to be covering reporting and interpreting cost of sales and inventory. So it's all about inventory today. So topics we're going to cover is what should actually be included, what costs should be included in inventory. What are the different inventory methods? So you may have heard of them. We have FIFO, weighted average, and specific identification. We're going to be focusing on how to find our ending inventory and cost of sales or cost of goods sold for a period. You're also going to learn about the inventory valuation method, which is the lower of cost and net realizable value. So LCNRV is the abbreviation for that. So let's just talk about what is the purpose of this chapter. So inventory, first of all, is important for any company, and it's what you sell to your customers. It's how you're going to make money. And essentially, on the exams, the entire point of what you're trying to find is you're trying to allocate cost between either your ending inventory or your cost of goods sold. So this is going to be on your balance sheet, and this is going to be expensed on your income statement. So really, most exam questions actually focus on this. It's an allocation of cost between the two. Your inventory will end up in one of those two places at the end of the year. So let's go over the basics of inventory. So what is inventory? So inventory is tangible property, so it's actually a physical good that's held for sale in the normal course of business or used in producing goods or services for sales. So inventory is what you use regularly for sales, and that depends on the nature of your business. So for example, if we have a restaurant and we own a delivery truck, that is not inventory, because this is the truck will be an asset that the business uses, but it's not inventory because we're not selling trucks. But if you're Ford, well, trucks are your inventory. It's what you sell in your regular business operations. So it's important to understand that it's all contextual in what type of industry you're in. So what costs are actually included in inventory? So you have the inventory price, which is what you paid for it. So this is like if you're going to buy 100 water bottles and they cost $1 each, so the invoice price would be $100. You also have to pay any import duties to bring it into the country. If you paid the delivery cost, you would have to add that to the cost of inventory, as well as any inspection costs you have to pay for. So it's basically any cost that was incurred to make the asset ready for use. So this is common. You're going to see this for any types of assets in general. It's anything to make the inventory ready for use or for sale. And that will be added to the cost. So the types of inventory, we have a few types. So raw materials inventory is anything that you would grow or you'd mine or you'd collect, and you'd use it to actually make products, to make goods. And so, this could be something like lumber, different types of metals, plastics, anything that you're going to use as a raw material to create other goods. Then we have work in process, or WIP, and these are goods that have been started but not completed at the end of the period. So the example for this, let's say you have an assembly line, and at the end of the day, right, the bell rings and everyone leaves, and they have a car that they were working on but they didn't finish making yet. Well, that will be part of your WIP, your work in process inventory. So it's goods that are partially completed, but we're not done making them yet. Once they've been built, they will go into your finished goods inventory, and these are ready for sale. It's goods that you've built yourself, and they're ready for sale. And the alternative, right, is merchandise inventory, and these are also ready for sale, but you didn't make them. You purchased them to resell it, right? It's merchandise inventory. So if you own a store and you buy goods from a manufacturer and then you resell them, right? So this is for retailers. Well, this is for companies that manufacture. Now, you don't need to know tons about every single type of inventory, but it's important to understand the basic distinction. And I just want to point out, this chapter, we're focusing a lot on, allocation of cost between ending inventory and our cost of goods sold. But really, inventory is in the territory of COMM 305. So we don't go too deep into it in this class. So when you take managerial accounting, next semester, next year, you're going to be learning a lot more about inventory. This is more the basics of it. So this here is very important, and you really need to know this. So I'm going to put a start. You need to know the cost of sales equation. And let's talk about it logically. At the beginning of the period, you're going to start off with your beginning inventory. So let's say you have $1,000 worth of inventory. Throughout the period, you're going to make purchases of inventory. So let's say we added $9,000, right? So this is what we purchased. So what we started, right? So this is what we began with. And what we purchased, that's going to give us our goods that are available for sale. So we would have $10,000, right? We add these two, so we have $10,000 available. And remember what I said about allocating between ending inventory and cost of goods sold? Well, whatever you had available in the year, it's going to end up in one of two places. Either you're going to sell it, so it goes into cost of goods sold, or you're going to have it left over at the end of the period, and that's your ending inventory. So we would then, at the end of the period, right, we would do a physical inventory count. So let's say, we found our ending inventory and we had 2,000 units left. So this is our ending inventory. So what we had available, less what we had left over, well, obviously, we sold through the rest. So 8,000 is our cost of goods sold. And you can do this the other way, right? If you knew what you had available, right, so we had 10,000 available, and you knew that you had sold through 8,000 units, well, you would know what your ending inventory should be, assuming that nothing was stolen or nothing was damaged in the period. So I want to show you guys what this actually looks like in a T account, and it's really, really important for you guys to understand this because you should understand how the inventory account is affected by all of these transactions. So I'm going to make a T account here for our inventory. So inventory is an asset. So assets have a beginning debit balance. So you're going to start off, right, with your beginning inventory. So we're just going to use random numbers like we did before. So we started with 1,000. Any purchases you had would be added as a debit. So that will be adding 9,000. And if we look back, right, our cost of goods sold was 8,000. So COGS 8,000. So what does that give us? Well, we have 1,000 plus 9,000 minus 8,000. So 1,000 plus 9,000 minus 8,000, and that gives us 2,000. And that's our ending inventory. So it's just important to understand this because if you know 3 of the variables, you can plug in for anything else. If you knew what your purchases were, you know what your COGS, if you knew 3 of the 4, you can figure out what the 4th one is. And often on the exam, you'll have to sort of use that logic and understand how the T account works to figure out the missing variable. So I want to talk about the difference between perpetual and periodic inventory systems and what they are. So a perpetual inventory system, under such a system, records are maintained throughout the period, right? It's perpetual. We're constantly keeping track. So we record each purchase and each sale in the accounting period. So you'd have, computerized inventory system, and anytime that a good was purchased or sold, you'd scan it and you'd keep track the entire time. So this is, most retail stores. So most retail, bigger companies will generally do this. They have the resources to manage their inventory in such a way. The other alternative is a periodic inventory system, and we do not keep track throughout the period, and rather, at the end of the period, we determine what our ending inventory and COGS are based on a physical inventory count. And so who would this be good for? It would either be good for really, really small businesses who don't want to keep track of every single purchase or sale because it could be expensive for your records, or it could be for a manufacturer, for some manufacturers who are using lots and lots of goods that are exactly the same, and they don't want to keep track of every single one that they use. So for example, if you have a factory and you're using millions of pieces of fabric, well, maybe you don't want to keep track of every single piece of fabric that you're using to make shirts or whatever other clothing item you're going to make. Rather, at the end of the period, you know what you started with, you know what you bought, so you just count what you have left, and whatever is the difference is what you would count as your cost of goods sold, right? So you have your beginning plus purchases gives you your COGS, which is your available for sale. Then you do your inventory count, and that gives you your cost of goods sold. So that's what you would do in a periodic system. There are some differences in how we actually account for it. So for up till now, we've only really learned the perpetual system, right? When you do a purchase of inventory, you debit inventory and you credit cash. So your cash goes down, your inventory goes up. And then every single time we do a sale, if you'll notice, we're keeping track of whatever inventory was actually used up in our cost of goods sold and our inventory. So we're actually keeping track every time that there's a purchase and every time there's a sale. And at the end of the period, you don't need to do anything special because you already know everything that you've purchased and sold already. You've kept track of it. Under a periodic system, when you actually make a purchase of inventory, you do not need to debit that right into inventory. Instead, it goes into a special account. So there's a special account called purchases, and this only exists under the periodic system. So throughout the period, you're adding to your purchases. Every time you make a sale, there's no entry for inventory or cost of goods sold. So we don't do it at the time of the sale. Rather, at the end of the period, we will add everything from our beginning inventory and our purchases into our cost of goods sold. So step one, expense everything. So that's all your beginning inventory and all your purchases. We would then do our physical inventory count, and we'd figure out what was in our ending inventory. So once we've determined that, so we would debit that amount, and we would decrease our expenses by that amount. So essentially, the assumption is you've used everything except for what you had left over at the end. So I recommend you take a look, maybe rewatch this section, just to understand the differences in the entries. So just remember, perpetual, there's nothing at the end, and you're keeping track of every single sale throughout the period. Under periodic, you're not keeping track of inventory at the time of each sale, rather you do it at the end of the period. So we're now going to take a look at the different inventory costing methods. So we have three methods. We have specific identification, and under specific identification, we actually recognize the cost of each individual item. So we know exactly what each item costs us. And so this is good for very high priced goods. So and unique goods. So stuff like artwork, for cars, right? A car dealership would know exactly how much this car cost. Stuff like jewelry, you would know exactly how much that would cost also. So specific identification is for when you're dealing with, high price and unique items, where you want to keep track of what that specific item cost. We're now going to look at FIFO and weighted average, and these are a little bit different. Under FIFO, you base the cost, so you are selling / costing items in the order you purchase them. So what you would do is you would actually keep track of the order you purchased items in and how much you paid for them. And the first item you sell, you're going to give it the cost of the first item you purchased. Under weighted average, you would take the average of the inventory, but it's weighted on the number of units you purchased. And don't worry, we're going to do actual problems to calculate each of these systems, and you'll understand how it works once we've run through some numbers. It's important to note that these are only different, so you're only going to get a different result when prices are fluctuating or changing, when prices are changing. Prices usually do change, though, due to stuff like inflation, increases in costs. Different materials will fluctuate in cost throughout the year, which is going to affect the prices of many other goods. So generally they do change, but it's just important to notice that if you purchased inventory for the same price the entire year, you would have the same results under each of these methods. And you can use each of these methods in a periodic or perpetual system, but the only one that could give you a different answer or a different solution for your ending inventory or cost of goods sold is your weighted average method. That is the only one that will give you a different method. Because think about it logically. Under specific identification, you're keeping track of each individual good. So it doesn't matter what system you're using, you're going to count each item as having their own individual price and cost. And under FIFO, you're selling it in the order you purchased it. So if that's the case, it doesn't matter what system you use, you've kept track of the cost of each good. So the only method that will give you a different answer potentially is weighted average. And we're going to look at each of the systems, and it's going to be a little bit more clear with hard numbers. So what I've done is I've actually created a little problem for us to do, and we're going to try and calculate the ending inventory and cost of goods sold for FIFO and weighted average. So the required for this problem is what is ABC's ending inventory and cost of sales. So we're going to start off by doing this under weighted average under the perpetual system. So if you recall, perpetual system, you are constantly keeping track of sales and inventory. So we're constantly updating our inventory based on the sales. And another term for this is moving average, because since we're keeping track of each sale, we're going to update the average cost with each right before each sale and with each purchase. So let's take a look back at our problem. So ABC Inc. has a beginning inventory of 100 units at a cost of $1,000. So let's take a look. So January 1st is going to be their beginning inventory, so the type of transaction will be beginning inventory. They have 100 units at a total cost of $1,000. Now this table here, I really recommend you use this table when you do inventory problems. It's very neat. You can use the same table for all of the different systems, and it's going to make everything a lot easier for you at the end to calculate everything. Now, there was no transaction cost this period, and there was no cost of goods sold for this period. So we just know that we have a total inventory worth $1,000, and we have 100 units in said inventory. So the next transaction is on January 1st, ABC purchased another 100 units for a cost of $1,100. So January 1st, we have a purchase, so that's the transaction. We bought 100 more units at a total cost of $1,100. All right, pretty easy so far, and we can just add if you want. The transaction cost here was $1,100. There was no cost of goods sold. Now, it's important to remember, under a perpetual weighted average method, what we do before every sale is we add up our total inventory and our total number of units, and we take the average unit cost. So we see that we have a sale coming up here, so what we're going to do is we're going to add it up. So we have $2,100 worth of inventory, and we have 200 units. So in order to get the unit cost, you would just divide 2,100 by 200. So 2,100 divided by 200, and that gives us a unit cost of $10.50. So on average, we paid $10.50 per unit. So we're going to take a look. On January 5th, we sold 150 units for $3,000. Now here, we do not care about the sale price. We are not concerned with it here. We care about the cost. We care about, because we're trying to figure out, for our books, what are we allocating between our ending inventory and what's going to be expensed in our cost of goods sold. So yes, the sale price is important, but not for what we're doing right now. So January 5th, we had a sale. So this was 150 units, so we'll put that in brackets. And this was going to be times 1050, which is our average cost, right? So we calculated that before. So 150 times 1050 gives us 1,575. That's the transaction cost. So where does this go? This goes into our cost of goods sold. We'll now take a look at our next transaction. On January 6th, ABC purchased another 100 units, but this time we paid $1,300 for it. So that was January 6th. We had a purchase of 100 units, and we paid $1,300 for it. Now we don't take an average just yet. We're going to take a look. And okay, January 10th, we sold 75 more units for $1,600. So what we're going to do is we need to figure out what we have left in our inventory. So we started with 200, right? So we're not concerned with what happened before the last average. We're just going to go from the most recent time we took an average. So we have 200 less 150, which gives us 50, plus 100. So we have 150 units. And now we're going to figure out the value of our inventory. So we had 2,100 less 1,575 plus 1,300. So we have 1,825 as our total inventory value. So we're going to divide that by 150 to get our average cost. So we'll round it to the nearest penny. So it is $12.17 per unit now. So you can see our average cost has increased, and that's because we paid more. We paid $1,300 for this newest batch of goods. So the price is going up for us. The cost is going up. And so we sold 75 units. So this was January 10th. And this is a sale. So 75 times 1217. So 1217 times 75 gives us a transaction cost. And we're going to round this to the nearest dollar, 913. So that's going to be our cost of sales this time. And it's important to note, for inventory, for unit cost, round to the nearest penny. But otherwise, round to the nearest dollar. So for individual units, yes, we do care about the pennies, but when we're talking about, a larger transaction, round to the nearest dollar. It's not important otherwise. So that's the end of our period. So what we're going to do now is we're going to add up each of the columns. So we have 75 units left. And we're also going to add up our inventory and our cost of sales. So we had 1575 plus 1913. So that's 2488 is our ending cost of sales. And we're going to subtract 913 from 825 to give us our ending inventory. So 1825 minus 913 gives us an ending balance of 912. So our ending inventory is 912. And our cost of goods sold for the period is 2488. So this is our solution for the problem. And you can see here, if you follow this table, you just need to add up everything in this column, and you'll have your COGS. And if you add up your inventory less your cost of sales, you're going to get your ending inventory. So if you want to try that again, go ahead. It's just practice, and you'll get to learn this table. We're now going to try the same problem again, though, with weighted average, but under the periodic system. So if you recall, under the periodic system, we only add up at the end, right? So we don't keep track of sales during the year. All we do is at the very end of the period, we do an inventory count, and that gives us our cost of goods sold. So under the weighted average period, we're first going to add up our beginning inventory and our purchases. Then we're going to take the average, and then we'll record our sales at the very end. So let's go back to our problem. So we had a beginning inventory of 100 units at a cost of 1,000. So January 1st, beginning inventory, 100 units, cost of 1,000. Next, we purchased another 100 units for a cost of 1,100. So we had a purchase 100 units at 1,100. Now we're going to skip this here. So we're just going to highlight this. So we're going to come back to it after. And we're just going to go straight ahead to the next purchase of inventory. So we purchased 100 units for 1,300 on January 6th. So 100 units for 1,300. Now take a look, and we have another sale. So these were all of our purchases. So what we're going to do is we're going to add up our total units, our total inventory, and then take the average. So we have 300 units. If we go over to our inventory, we have 3,400 as our total inventory. So what we're going to do is we're going to divide that by 300 to get our unit cost. So 3,400 over 300, and that will give us an average cost of $11.33 per unit. And now that we've calculated that, we can start to record our sales and figure out what our costs are going to be for the period. So our first sale was 150 units, and that was on January 5th. So January 5th, we have a sale, and we also have a sale on January 10th of 75 units. So that was 150, and January 10th, we have a sale of 75 units. So we can just multiply each of these by 1133 to figure out our transaction cost. So 150 times 1133 gives us 1,700. So we're going to round to the nearest dollar, right? Because we got 1699.5, so we'll just round it up to the nearest dollar. And we sold 75 units on January 10th, so 1133 times 75 gives us 850. And these are going to go into our cost of sales because these are products that we're selling through. So it's very simple, it's very quick, it's a lot faster than the other method. And at the end of the period, we can just take our totals. So 850 plus 1,700 gives us 2,550. And for our ending inventory, we have 3,400 less 2,550. So that gives us our ending inventory of 850. So the cost of goods sold is equal to 2,550, and our ending inventory is equal to 850. And that is our solution for this problem. And if you take a look, actually, at our previous problem, our ending inventory was 912, so we had a higher ending inventory, and we had a lower cost of sales. Why do you think that is? Well, the reason is because we also took into account the sales of items that we purchased at a higher price and gave it the same weight from the beginning. While under the perpetual system, as we were selling through items, they were taken from an average of items that we paid less for. So the cost base was lower as we were taking the average. And this will, as you go through a few problems and you compare your solutions, you're going to start to see this. We're going to go over some of the rules for it after. And finally, we're going to do the FIFO method. So what's important to remember for FIFO and what distinguishes it from weighted average is that we need to keep track of exactly how many units are in our inventory and what we paid for each unit. So we actually have to keep track of it, which is a little bit more difficult, but it's okay. We'll get through it. So we start off the period, right? So we had a beginning inventory of 100 units at a cost of 1,000. So January 1st, beginning inventory, and we had 100 units at a cost of 1,000. So what we're going to do is we're actually going to take the average right now. So 1,000 divided by 100 means that we paid $10. So we have 100 units at $10. That's the price we paid for it. I'm going to go to our next transaction. We purchased another 100 units for a cost of 1,100. So we're adding this to our inventory. So January 1st, we had a purchase 100 units at, and we're going to take a look in a second. So we purchased it for 1,100. So 1,100 divided by 100 gives us 11. So if we look at our inventory right now, we have 200 units, right? 100 that we paid $10 for, and we have 100 that we paid $11 for. And we're keeping track of how many units we bought at each price, because when we sell through them, we're going to sell through it in the order that we purchased them. So our next transaction, we sold 150 units. So let's do that transaction. So on January 5th, we had a sale. Now we sold 150 units. However, what we need to do now to figure out the cost is we need to go back to what we have in our inventory. And we're going to sell through it in the order we purchased it. So what I'm going to do So I'm going to move this 150 over to the side here. And we're going to keep track of what the cost of each unit we're selling is. So we go to the beginning of our inventory, and we start off with 100 units that we paid $10 for. So we have the first 100 here. We're going to sell through it at $10, but we still have we still have 50 more units to sell through. So we go to the next units that we purchased. So we saw here that we have 100 units that we bought at 11. Now we're not going to sell all of them, but we are going to take 50 of those units and sell those. So 50 units at 11. And what we're going to do just quickly before we figure the transaction cost is we're just going to do a subtotal, and we're going to figure out what we have left in our inventory. So we got rid of this completely, and of the 100, we sold through half of it. So we still have 50 units remaining at $11 because we want to keep track of what we have at all times. Now we're going to multiply and figure out what these transactions cost us. So 100 times 10 gives us a transaction cost of 1,000, and 50 times 11 gives us a transaction cost of 550. And these are going to go into our cost of sales. And there you go. That's how we did our first sale. So we still have remaining, and if you want, you can write here remaining as the type of transaction. This is what's left in our inventory. We're now going to go to our next transaction. So on January 6th, we purchased 100 units for $1,300. So January 6th, we had a purchase of 100 units for $1,300. So 100 at, and so 1,300 divided by 100 gives us an average cost of $13. So this is our inventory right now, and you see here we're keeping track of exactly units we have. Once we're keeping track of what we have, we can actually just add this into our inventory at the very end at our total, right? This is our total inventory category. This is our column for that. So 50 times 11 gives us 550, and 100 times 13 is 1,300. So this is what we have in our inventory right now. So let's take a look at our next transaction after January 6th. So on January 10th, we sold 75 units for $1,600. So once again, we don't care about the sale price here. And this is a common trick that you're going to get on the exam. They're going to give you the sale price. It's not necessarily important unless they're asking you to do something specific with that. We care about cost here, trying to figure out the costs of our inventory. So January 10th, we had a sale of 75 units. But remember, we need to sell these in the order we purchase them. So we go to our most recent inventory. So that's over here, right? So we're going to only look at these guys here because this is what we have left in our inventory. And we're going to go through them in the order we purchased them. So 75 units, so we start from the top. We have 50 units here. So we're going to sell through those 50. And how much do we pay for it? We paid 11 for it. So 50 at 11. But we still need to sell another 25 units. So we go to the next line. We have 100 units that we purchased for 13 each. So 25 at $13 a unit, and that is our sale. So we're going to calculate that. So 11 times 50 is 550, so we can put that straight into our cost of goods sold. And we had 25 units that we bought at 13, so 25 times 13 is 325, so we'll put that into our cost of goods sold as well. So what do we have left over? Well, these 50 we sold through, and of the 100 here, we only have 75 remaining. So that's going to be part of our ending inventory. So 75 units, and how much do we pay for them? Well, we paid 13, so 75 at $13. So 75 times 13 is 975, and that's going to be our ending inventory for the period, $975. And for our cost of goods sold, we can just add up this column over here. So we're going to add this all up, and that's going to be our cost of goods sold. So we have 1,000 plus 550 plus 550 plus 325, and that gives us an a cost of sales of 24.25. So our required, right, is get your ending inventory and get your cost of goods sold. Well, our ending inventory is $975. And our cost of goods sold is $24.25. So you can see here under the FIFO method, we've kept track of every single unit in our inventory, the price we paid for it, the order we purchased it, and we made sure that when we were going to have sales, we calculated the cost based on the order we purchased it in. And it's really important to do that. That's the entire point of the FIFO system. And whether you had a perpetual or periodic system, you would have the same results with FIFO either way, because you're selling them in the same order. So let's have a quick talk about why management would choose one system over the other. So the base assumption that we're going to make for this is that costs are rising. That we have to have that assumption before we have a discussion. So under FIFO, if costs are if costs are rising over time, right? So let's say you bought some units at $10, then you bought some at $11, then you bought some at $20. Under FIFO, we're selling through items and we're keeping track of the order that we purchased them in. So we're starting off by sell these first. Then this is going to be sold second, and then this will be sold third. So if we're selling them in the order we purchased them and costs are rising, under FIFO, you are selling the less expensive inventory first. So if your inventory is going to be less expensive, it's going to result in a lower cost of goods sold. And if that's the case, it's going to give you higher net earnings. So assuming costs are rising, you would choose FIFO because it would give you a higher net income at the end of the period. It would also give you a higher ending inventory, so more assets. And so for a lot of managers who may have bonuses based on net earnings, they may want to choose FIFO because they want to show higher earnings and get their bonus. So they have a financial incentive to do so. Under weighted average, however, remember, we took the average of these prices before we sold them. So if that's the case, you're going to have a higher cost of goods sold, and that will mean a lower net earnings. And if your earnings are lower, you're going to have lower taxes. So it's not forever, you'll have to pay it eventually, but you would defer your taxes. So you could hold off paying them. So you would hold off until you had that net income. So you can push off paying it. So some managers might be more concerned with keeping cash in the company and would rather show lower earnings for that. Now remember, this is all on the assumption that costs are rising. In a period of declining costs, the opposite holds true. So if it was declining costs, weighted average would be higher net income than FIFO. And if costs remain the same throughout the year, you would have the same results regardless of the system. So if you recall, we began today's introduction and we mentioned LCNRV, lower of cost and net realizable value. And we're going to talk all about that. This is a topic of inventory valuation. How do we value our inventory? So before we get into that, let's define NRV, net realizable value. And that is your expected sales price minus your selling cost. So NRV is sales price minus sales costs. So for example, if you were to sell a good for, $110, but you had to pay $10 to sell it, whether it's through commissions or whatever, your net realizable value would be 100. It's the net amount that you would realize from the sale of that good. So we value our inventory at the lower of cost. So this is what we paid for it. If you remember, we include anything to make it ready for use. So it's the lower of cost and NRV. So essentially, we will just look at cost and NRV, and whichever is lower, that's going to be how we show our inventory on our balance sheet. Now, normally, it's always shown at cost, right? We start off by showing it at cost. So if NRV was to be less than cost, we would have to write down our inventory. We'd have to recognize a loss to write it down, to decrease the asset. If your cost is less than your NRV, do nothing. That's fine. That's normal that you should sell a product for more than it cost you. So when NRV drops below cost, this means that your inventory is now worth less than you paid for it. So how do we actually recognize the loss? Well, there's a special journal entry. So what we do is we first of all debit to cost of goods sold, meaning we recognize the expense right away. We don't wait till we sell it. Right away, we're going to debit to COGS the difference. I'm going to get to the numbers after. We're just going to focus on the journal entry for now. And you would credit allowance for inventory write-downs. You could alternatively, or you could credit inventory directly. They're both acceptable. So how do you get the number? Well, it's just the difference between the two. You take the cost minus your net realizable value, right? So let's just give random numbers. So we said before our NRV was going to be 100, and let's say we paid 120 for it. So the difference would be 20, and that is the amount to write down. It's the difference. It's cost minus NRV. That is how you get the number values for this journal entry. And finally, we're going to end off today's lecture with discussion about ratios, and then we're going to jump back into a Java Joe problem. So we have two ratios today. If you recall from Chapter 7, we had the receivables turnover ratio. Well, now we have the inventory turnover ratio, and this measures how quickly or how many times a year you turn over or sell through your inventory. So it's your cost of goods sold divided by your average inventory. So let's say your cost of goods sold for the year was 1 million, and on average you had $200,000 of inventory. Your ratio would be 5. You, on average, sold through your inventory 5 times that year. And of course, you want a higher number, because if you have a very low number, it means that you have too much inventory, or you're not doing a good enough job selling it, or it means that nobody likes what you have to sell. Maybe your inventory has become obsolete, and that could be a very high risk for an inventory write-down if it becomes obsolete, if the price drops for it. The next ratio is the average days to sell inventory. So it's 365 days divided by your inventory turnover ratio. So we'll use what we calculated here, so 5 times. So 365 divided by 5 gives us 73. 73 days. On average, we sell through our inventory every 73 days. So a lower number is better. And we're going to end off now by discussing our Java Joe problem of the lecture. So this one here is going to be a bit of a different problem. It's more theory-based because I've already shown you how to calculate your ending inventory and your cost of goods sold, and I've shown you how to do write-downs. Instead, I'd like you to think about the different inventory methods and why you think Java Joe should use one or the other. Which of the three, FIFO, weighted average, or specific identification? Remember, they're a coffee shop, so they have stuff like coffee beans, they have milk, they have, maybe they have some baked goods or food. And that's basically their inventory. So which of the three do you think they should use and why? And I'd like you to maybe pause and just think about it and try to come up with whatever ideas you can, and then we'll solve it together. So the first thing we're going to do is we're going to eliminate one of the options. We're going to eliminate C. C is wrong because you should really only use this for unique items. It doesn't make sense to calculate how much each pound of coffee, each individual pound or each coffee bean or each container of milk costs. So C we're going to eliminate right off the bat. So we're stuck between FIFO and weighted average, and I will say that you can make good arguments for both. They would both be acceptable for different reasons. So let's talk about both of them. FIFO is first in, first out, meaning that you sell first through the inventory you purchased first. So let's think, is this representative of their operations? Well, yes, this is very representative. They're a coffee shop, so they're selling through, milk, coffee beans. These are all goods that can go bad over time. They're perishable. So they want to sell through the first coffee beans that they had while they're still fresh. They want to sell through the first milk that they purchased before it spoils, and the baked goods are maybe only good for a couple of days. So it's very representative of their operations, so you could very well argue that they should use FIFO. However, there are increased costs. So that is a negative. There's a lot of bookkeeping and accounting, right, to keep track of the order you purchased it in. So maybe as a smaller coffee shop, Joe's going to say, you know what, I don't need to keep track of exactly which bag I purchased first and how I'm going to sell them and keep track of all those prices. That's going to be a real pain, and it's going to be very expensive for me to do so. Instead, he might want to use weighted average. And even though, he is selling them in the same order, it's a lot easier and lower cost. And you want to remember, in financial accounting, you want to consider the cost constraint. How much benefit do they get, does the user of the financial statement get, for the cost? And do we really need to pay hundreds of dollars or thousands of dollars to keep track of, something that's constantly moving, the inventory, we're eventually going to expense it, and the differences aren't too huge between the systems. And it could be that he's paying the same price year round. So I would say that you could make arguments for either FIFO or weighted average, and whichever one you answered isn't as important. What's important is to just understand the logic, and if you were able to give some good arguments for one or the other, that's great. That's really good. So read your books, review the ratios, because once again, we don't go super into detail, and practice the table and review this lecture, because inventory, if you get it, it's not too hard to do well on your exam. So we wish you best of luck on your exam, and we wish you to see you in the next lecture. Thank you so much.